What if I told you that banks aren't rich because they keep your money, but because they make that money silently work everywhere? Why could banks that once held over $108 billion in deposits like Washington Mutual or over $200 billion in assets like Silicon Valley Bank collapse in just a few days or even a few dozen hours? Behind the glamorous buildings is a money-making machine relying on interest rates, small fees, and the most fragile thing of all, customer trust. But when trust disappears, everything changes with it. Let's explore this surprising and thrilling story with me to understand what is truly running the entire banking industry. The world's biggest safe is actually almost always empty. If you ask 100 people on the street how banks make money, most will probably give the same answer. They keep customers' money and charge fees. Sounds very reasonable, but that is just the outer coat of paint on a much more complex machine. I still remember a conversation with a former bank executive in New York. He placed a $100 bill on the table and smiled. "If this bill stays in the safe, it won't earn a single cent." "What do you mean?" "It has to disappear." That answer made the room go silent for a few seconds. It sounds strange. People bring money to the bank because they believe the money will sit still in the safe, waiting for the day they return. But the truth is exactly the opposite. The moment the money is deposited into the account, it almost begins a new journey. It could become a home loan in Texas. It could be used to help a small store in Florida expand its business, or silently flow into government bonds, where every single coin continues to spawn many other coins. The depositor still opens their banking app and sees their full balance. Everything looks completely normal. But behind the screen, that money has started working in many different places. That is the first secret. Banks don't get rich by storing money. They get rich by making sure the money never rests. Imagine a bakery. Flour sitting in the warehouse won't generate a profit. The owner must take it to make cakes, sell them to customers, and then continue buying new ingredients. Banks operate in much the same way. Only one very important difference. Their ingredient isn't flour, it's other people's money. A loan officer once joked with me over coffee, "Money is like water. Less still, it has no value. To generate electricity, it has to flow." That saying sounds simple, but describes almost exactly the entire banking industry. Every day, millions of deposits constantly pour in and are then converted into loans, investments, and countless profit-generating assets. It is that flow that feeds the whole machine. The strange thing is that most customers don't even realize this. They only see the number in their account remaining intact, so they believe the money is still exactly where it was. That belief becomes the most valuable asset any bank possesses, because as long as the money continues to circulate, the machine still generates profit every minute. But also from that moment, a big question begins to emerge. If that money is everywhere out there, then what would happen if one day everyone wanted to take it back at the same time? The real money-making machine lies in a gap of just a few %. The question at the end of the previous part still hangs in the air. If customers' money is constantly being sent out to make a profit, then how much does the bank really make from each of those dollars? I once sat in front of a financial report hundreds of pages thick from a major US bank. What surprised me wasn't the massive numbers, but a very small one, just about a few %. It sounds almost not worth caring about. But that is exactly where tens of billions of dollars are generated every year. A financial expert smiled slightly when he saw me staring at the spreadsheet. "Are you looking for the big number? I thought the profit must be very high." He shook his head. "No, the secret lies in the gap. That gap is the difference between the amount the bank pays depositors and the amount they collect from borrowers. Suppose you deposit $10,000 into the bank. At the end of the year, you receive a fairly small amount of interest. You are satisfied because your money remains safe. Meanwhile, that very same money has become part of a loan to buy a house, buy a car, or start a business with a significantly higher interest rate. The bank doesn't keep the entire difference. They still have to pay salaries, invest in technology, and maintain a massive system. But the remainder is the engine that keeps the machine turning. The interesting thing is that if you look at each individual customer, the money the bank makes is nothing special. One loan generates a few $1,000s, another one a few tens of thousands. Sounds very normal. But then take a few steps back. Look at the whole picture. 1 million customers, 10 million customers, hundreds of billions of dollars moving together. At that point, a gap of just 2 or 3% suddenly turns into numbers that make anyone pause for a few seconds. A former analyst once told me, "People always think banks win big thanks to one heavy strike." He tapped his pen lightly on the table, while the truth is, they win thanks to millions of very small taps. That is what few people notice. The bank doesn't need every customer to bring in a huge profit. They just need millions of transactions to happen every day, as regularly as clockwork. Every loan, every card swipe, every mortgage contract, every business needing capital, every person buying their first car, all contribute a very small part to the same massive cash flow. That is why major banks are constantly expanding their scale, not for $1 million loan, but because they want to own millions more customers. Because in this world, the biggest profit doesn't come from a single deal. It comes from turning very small profits into a giant wave, repeating every day. But then I realized something even more worth thinking about. If this machine lives on the gap between deposit and lending interest rates, then what would happen when that gap suddenly narrows after a single decision by people sitting around a meeting table in Washington? The real gold mine actually lies in very small amounts of money. If they only look at interest rates, many people would think they understand how banks make money. But after months of tracing the financial reports of the biggest banks in America, I realized something else. The interest rate is just the main engine, and behind it are dozens of small gears silently turning day and night. The remarkable thing is that most customers almost never notice them. One afternoon in Chicago, I met a former retail banking director. He opened his phone, showing me the transaction history of a normal account. "Look for anything special?" I looked for a while, then shook my head. "There's nothing." He laughed. "Precisely because you don't see it, it's effective." Each fee that appeared was very small: a money transfer, a currency exchange, an account maintenance fee, a card usage at a store, a fee for transacting abroad. None of them large enough to make the customer stop and think. But when tens of millions of people execute the exact same transactions every day, those small coins start merging into a giant river. That was when I understood why banks always want customers to use as many services as possible. Not just depositing money, not just borrowing money. They want you to use cards, open more accounts, invest, manage wealth, pay bills, transfer money internationally. Each service is like a new door leading to another revenue stream. A business specialist once said very bluntly, "Customers just think they are using a card." But behind that card is an entire ecosystem. Every time the card is swiped through the payment terminal, multiple parties receive a very small cut. The seller rarely notices, the buyer notices even less, but the bank always knows exactly where the cash flow is going. I began to notice a rather interesting rule. Banks don't like to depend on just one source of revenue. If the lending market slows down, there is still revenue from cards. If card transactions drop, there are still investment services. If investments go down, there are still a series of other operational fees continuously flowing in every day. It's like a ship with multiple engines. If one engine weakens, the remaining engines are still strong enough to keep the whole ship moving forward. It is that diversity that makes large banks almost always look for ways to open new services instead of just opening more branches. They don't just want to keep the customer's money. They want to appear in almost every financial activity of the customer, from the moment they receive their salary to buying their first cup of coffee of the day to when they sign the contract to buy their first house. And upon closer observation, I started to realize something even more noteworthy. Banks are making money from many different sources, but all those revenue streams have one thing in common. They only operate smoothly when the customer's trust remains completely intact. The biggest secret is that banks are playing with other people's money. By now, the picture has gradually become clear. Banks make money from interest rate differentials. Banks collect a series of small additional fees that almost no one notices. But there is still one question that had bothered me for years. If the profit on each loan is only a few percent, why can many banks still generate numbers that even the biggest manufacturing corporations can only dream of? The answer lies in what very few customers see. Not the glass buildings, not the rooms full of screens, but the source of money they are using. A former risk management director once pulled his chair closer to me and spoke very quietly. "Do you know what the most interesting thing in this industry is?" "I guess it's the loans." He shook his head. "No, we almost never use our own money." The whole room suddenly went silent. At first glance, that statement seems hard to believe, But the more I looked into it, the more I saw that this was the true nature of the whole machine. A normal business that wants to expand has to put in more of its own capital. Want to build another factory? You have to borrow or call for more investors. Want to produce more? You have to spend more money. Banks operate in almost the exact opposite way. Their biggest source of fuel is the very money that millions of customers voluntarily bring in to deposit every day. Because of that, they don't need to own hundreds of billions of dollars to generate hundreds of billions of dollars in transactions. They just need to keep that cash flow moving constantly. A financial specialist once gave a very easy-to-understand analogy for this. Imagine you are driving a truck. If you only use your own gas, you will go a certain distance. But if the whole city contributes fuel for you, the truck will run very far. That is exactly what makes banks different. They don't try to make a lot of money from a small amount of capital. They generate profit on a massive amount of money, most of which doesn't belong to them. The larger the scale, the stronger the efficiency. That is also why banks are always looking for every way to attract more depositors. Each new account brings not just a customer, it also brings more fuel for the entire system. The interesting thing is that customers still feel completely secure. They open the banking app, the balance is still intact, everything is normal. Few people think that at the same time, their very own money is contributing to generating profits in many other places. The more I observed, the more I saw the banking industry as a giant bridge. Millions of people step on it every day without knowing that the entire weight is being held by very thin cables. As long as people still believe, the bridge stands firm. No one asks questions, no one looks down below. But right at that moment, I realized a thought-provoking paradox. The more a machine generates huge profits by using other people's money, the more it will depend on the trust of those very people who brought that money in. And in the banking world, just as soon as trust begins to waver, the numbers that once made everyone admire them can turn into pressure in a very short amount of time. Behind the glamorous. Buildings is a relentless money, devouring machine. At this point, many people probably think the bank really is a perfect money printing machine. Customers' money continuously flows in. Profits come from interest rates. Then countless small fees appear every day. Sounds like a game where the victory always belongs to the bank, but that is only what people see from the outside. Behind the doors of those glass headquarters is another battle, much more silent. I once asked an executive of a regional bank in the US, if the bank makes so much money, why do you always look so stressed? He burst out laughing. Because every morning I open my eyes, the cost meter has already started running before the customers even walk in. He wasn't exaggerating. A bank cannot just open its doors and wait for the money to find its way in. They have to maintain thousands of employees, the people who approve loans, the engineers who keep the system running day and night. The data protection team constantly monitoring every abnormal signal. Lawyers, auditors, customer service representatives, just the monthly payroll alone is enough to overwhelm many other businesses. But that is only the tip of the iceberg. A technology expert once took me into a bank's data center. There was no talking, only the sound of cooling fans and long rows of servers running non-stop. He pointed toward the rows of metal cabinets. This is where money is spent the fastest. Every minute, every second, every wire transfer, every card swipe, every time a customer logs into the app, all need to be processed almost instantly. Just one small error can cause the whole system to wobble. Therefore, banks are forced to invest continuously. New servers, new software, new layers of protection. They have no other choice. Then there is an expense that few people think about. Those are the funds set aside specifically in case some loans don't go as planned. Not every business thrives. Not everyone buying a house always has an easy time. The bank understands that before even signing the contract. Because of that, they always prepare a financial cushion for tough days. A risk management specialist once told me, the most dangerous thing isn't losing money today. It's losing money tomorrow, but not being prepared today. That saying stayed with me for a long time. It explains why the profit the public sees and the money actually retained are always different. On the outside, the bank seems to be raking in massive numbers. But on the inside, every dollar of profit is constantly being divided to feed a massive machine that operates 24 hours a day. And precisely when observing those enormous expenses, I began to realize something even more worrying. A bank can endure huge costs. They can also overcome a few troubled loans. But what would happen if a sufficiently large fluctuation occurred, causing both revenue and customer trust to begin to shake at the same time? The most dangerous thing is not money, but the moment every yuan loses trust at once. Here, I finally understood why many banking leaders aren't afraid of normal days. What keeps them awake at night are the days when everything suddenly changes too fast. One morning, the bank is still operating like every other day. Customers make transfers. Cards are still swiped. Loans still bring money in, but if just one link changes, the whole machine can start to slow down. I once asked a former liquidity management expert, if you had to choose the one scariest thing in the banking industry, what would you choose? He answered immediately, without thinking. Interest rates. At first, those two things sound unrelated, but in reality, they always travel the same path. When interest rates change, banks cannot instantly change every loan signed years ago. Many contracts still keep the old rates. Meanwhile, to retain depositors, the bank has to pay a more attractive rate. The gap that once created profit begins to narrow, cash flows in slower, costs rise faster. A chief financial officer once took a pen and drew two straight lines on a piece of paper. This line is money in, this line is money out. He looked at me. If just these two lines swap places. Nonsense. Everything will be different. No need for a storm, no need for a massive crisis. If just that balance is broken for a long enough period, pressure will appear. But interest rates still aren't the most concerning thing. What really makes the whole system as tense as a violin string is trust. Banks can handle thousands of customers withdrawing money every day. That's normal. What is abnormal is when hundreds of thousands of people all think the same thing. I better withdraw my money first. That thought spreads faster than any news bulletin. One call, one text, one post on social media. Then this person calls that person. Friends text each other. Family asks one another. No one knows how true the information is, but so many people are afraid they will be the ones coming in last. A teller once recounted, in the morning the counter was still very quiet. By noon, customers lined up filling the entire lobby. That same afternoon, the phone almost never stopped ringing. The notable thing is that most of those people didn't know each other. They just collectively reacted to the exact same feeling. And that is the biggest weakness of the banking industry. This machine is built with money, operated by technology, protected by the law. But what keeps it standing firm every day is the trust of millions of people. If that trust just begins to crack even a little bit, the numbers that once brought a sense of security can quickly turn into massive pressure. And from that very moment, I started to understand why, in American history, there had been banks once considered symbols of solidity, but after just a few short days turned into a lesson that made the entire financial industry have to reflect upon itself. WHEHE appears, an entire empire can vanish after just one weekend. After months of tracking a series of financial records and the incidents that once shook Wall Street, I noticed a commonality that most people overlook. No major bank collapsed because they didn't know how to make money. Quite the opposite. Most of them used to be incredible profit-generating machines. They had millions of customers. They owned hundreds of billions of dollars in assets. They had highly experienced management teams. But then, in just a few short days, all of those things almost lost their meaning. Washington Mutual was once considered a symbol of the American banking industry. For many years, they continuously expanded. Branches appeared everywhere. The customer base grew larger and larger. Profits still flowed in steadily. No one thought such a massive institution could disappear so quickly. Then, one day, things started to reverse. A customer walked into the branch. "I want to withdraw all my money." The teller still smiled. "Sir, we will assist you right away." A few minutes later, many more people appeared. Then the line stretched all the way outside. No one shouted. No one panicked. They just shared the same thought. If others are withdrawing, I shouldn't wait either. That was when the machine that had operated smoothly for many years started to slow down. The money was still on the balance sheet. The assets still existed. But time was no longer on their side. Many years later, an almost identical story appeared with Silicon Valley Bank. This time, it was even faster. No more long lines outside the bank doors. No more scenes of customers holding their savings books waiting. Everything happened on phones. A text appeared in a group chat, then another text. "Move the money," just 3 words. But its spread was faster than any television news broadcast. A few minutes later, dozens of companies simultaneously submitted withdrawal orders. A few hours later, the number had reached tens of billions of dollars. Not because the bank suddenly had no assets left, but because they couldn't turn those long-term assets into cash fast enough to meet too many requests at the same time. It was a race against time, and time won. A former banking supervision official once told me a very memorable sentence. Banks don't die on the day the money runs out. They start getting into trouble on the day the trust runs out. That is perhaps the most accurate concluding sentence for this entire story. Throughout 7 parts, we have traced every link of the banking machine, from how the money is put into operation, how they create profit from interest rate differentials, from the almost invisible small fees, to the power of financial leverage and the enormous costs behind it. In the end, it all leads to the same point. A bank is not a giant safe full of money. It is a machine operated by trust. When trust still exists, money continues to move and profits continue to be generated. But when trust begins to disappear, even just by a text message, a rumor or a wave of anxiety spreading too fast, an entire financial empire built over decades can come to a halt in just a few days, or even after just a few dozen hours. Perhaps that is the coldest truth of the banking industry. The most valuable thing they hold has never been money, but the trust of their depositors.